Commodity, welcome ladies and gentlemen here in our studios in Munich, and with me here is now James Wellsted, the Senior Vice President of Investor Relations from Sibanye Stillwater. The largest gold producer from Africa actually, and the company is becoming the second largest platinum palladium producer in the world after the takeover of Lonmin. James, welcome. Great to have you here. Yeah, thanks for taking the time. I mean, your company, we could talk an hour about that without any problem, but I think we should maybe touch on the things which are really going on. You took over Stillwater, which I think was a phenomenal deal because it helps you now a lot to maintain profitability in the company. Now you're buying Lonmin. So what's the possession behind?
Yeah, I think we need to probably step back one step though. I think, we started life as a gold company, totally located in South Africa with a few relatively mature assets. And then we made the decision some years ago to move into the PGM sector. And we had a four-step strategy all along, but I think we've managed to complete that strategy quite quickly, or quicker than we thought. And that involved, first of all, buying two key assets in South Africa, being Aquarius Platinum, which was an Australian and London-listed asset with company with mines in South Africa and in Zimbabwe. And then we acquired Rustenburg Platinum from Anglo American Platinum, and we put the two together, and we were able to unlock significant cost benefits and synergies by doing that. That immediately...
Can you quantify them a little bit?
Yeah, so I mean, first of all, by putting them together, we immediately became one of the top 4 producers in the world, producing about 1.1 million ounces of platinum, palladium, gold, and rhodium per annum. And we expected to realize about $70 million of synergies over 3 to 4 years. And in fact, we got about 85 in 1 year.
Nice.
Which moved the assets immediately from the top half of the cost curve into the bottom half of the global cost curve. And assets that were making huge losses are now profitable within a year. So that was very successful. We had another step in South Africa, which we wish to conclude, which was to become a fully integrated producer, all the way from the workface all the way through to refined metal. And that is the step you spoke about earlier, being Lonmin. But before that, we did a transaction in North America where we acquired Stillwater Mining, which is the largest primary palladium producer in the world, and the biggest producer of PGMs in the USA. And that's been a very good acquisition for us. It allowed us to diversify the commodities that we produce with a bigger focus on palladium, which, as you know, has been one of the top performing metals in the world in the last year or two. And also geographically to shift the focus away from being pure South African production to having a stable base in the USA, and also not being exposed fully to the currency in South Africa, which recently has strengthened quite a lot and has been putting a lot of pressure on margins in South Africa.
So that means you have diversified the risk also in the company.
That's correct.
And you put it on more solid columns, right?
That's correct, yeah. So by diversifying to the US, the perceived risk, those assets should be valued higher and with less of a discount than perhaps the South African assets might be.
Okay. As you just said, valuation. I think valuation is something a lot of analysts have a little bit of a problem, I would call it. Maybe you can elaborate a bit on that, because your share price is quite low. I think it's a super opportunity, but that's my personal opinion, of course. Everybody has to do this by himself. But can you elaborate a bit why, let's say, the stock is under pressure?
So I think, first of all, we've gone through a lot of change. As I said, from being a gold-only producer from South Africa, we are now in the top 3 PGM producers in the world as well. And we've done a lot of deals, particularly in the last 12 to 18 months. We've concluded a number of deals. And because of all the change, I think the market has struggled to really keep up with the pace of change, and to fully understand what the sustainable company is going to look like. Secondly, with the Stillwater transaction, which was a big transaction, we acquired it for $2.2 billion US, and with it we raised quite a lot of debt. We've always been a company that's had very little debt, and good cash flows and paid good dividends. And for a period now, because we've had to raise debt for that acquisition, we are now focused on reducing our debt, and we're not paying cash dividends for a period.
But you still pay dividends,
we will
right?
pay. We do pay dividends.
Yeah.
We issued our shareholders with a capitalization issue, which is shares. We issue them with shares for every 100 that they own. So essentially, it's to replace the cash dividend.
But I think the Swiss would love you for that because they don't pay taxes on it.
And certainly, we intend to return to a cash dividend as soon as possible. But the focus at the moment is to try and reduce that debt. I think the market is a bit concerned about the levels of debt we've got at the moment, particularly with the strong rand impacting on margins on our gold assets and PGM assets in South Africa. We know that we're in a very solid position and we are comfortable with our debt at the moment. We will obviously be addressing it over time, and we have a number of different levers to pull which can reduce that debt. But I think those are the concerns and what's weighing on the market at the moment.
Absolutely. But you have enough optionalities and let's say possibilities to really solve that, not in 5 years, but to solve in the next 12 to 18 months, I would say.
Sure.
Right?
And that's operational levers we can pull, is addressing costs, addressing capex that may not be essential at the moment, but then also some financial levers we've been looking at before. Last year, when we were looking at refinancing part of that bridge facility that we raised for the Stillwater acquisition, we were considering a stream. And at that time, the indications were that we could raise quite a substantial amount of money, about $500 million, which is essentially about a quarter of the acquisition price that we paid for Stillwater, by streaming, 5 to 6% of the revenues or the production. So that would be a very positive, I think, transaction. If we could raise that sort of money, we bring our net debt to EBITDA down to about 1.8 times almost immediately, which means that we're very far from breaching covenants at that stage.
Absolutely. Let's come a bit to the operational side for 2018. What is, let's say, the growth profile at Stillwater, or let's say also on the platinum palladium side, and what are your plans on the gold side?
So on the gold side, we're relatively stable. We have recently restructured the gold operations for a lower price environment. We closed some operations last year, which reduced our overall costs. In South Africa, the PGM, again, the operations we already own are quite stable. We're producing about 1.1 million ounces of 4E PGMs, and we're producing about 1.3 million ounces of gold. We are looking at an acquisition to acquire Lonmin, which would add about 800,000 to 1 million ounces of 4E to our current production base. And then at Stillwater, which is really where the growth comes in, Stillwater is currently producing about 550,000 ounces a year. And over the next 3 to 4 years, we'll be growing its production almost 50% to 850,000 ounces. And at the same time, reducing its costs as that production increases.
Great. So that means the margins are going sharply up, right?
Significantly. I mean, at current market prices, with palladium at about 950 and platinum at about 930, that would put us on about a 45% all-in sustaining cost margin, which is after our capital.
Super, that's really healthy. Great. Can you give us also a little bit of an idea what, let's say, the mine life total of the company is, and what measures or what actions you want to take maybe in the future to maintain the long mine life?
Yeah, I mean, again, the initial perception when we listed in 2013 was that we had relatively short life, mature operations. Exactly. And these gold assets are quite old. I mean, some of them have been operating for over 70 years and produced over 100 million ounces of gold. But they still have a lot of life in them. And we currently have got a life of mine of about 20 years in the gold. In the PGM in South Africa, in excess of 20 years, and then Stillwater is anything from 30 to 50 years. Super. Obviously, in a higher price environment, we've got significant optionality where we can develop projects in all of both the gold and the PGM in South Africa, as well as Stillwater, which would significantly extend the life. So these are very robust and long life assets.
Yeah, great. Can we shortly touch to the end of the interview a little bit the situation of, let's say, South Africa, maybe also also Zimbabwe, if you want to like to comment, because we had there, really large political changes, and I think things are improving.
So both of those countries, which is where we've got operations, we've got a joint venture in Zimbabwe as well, and both of them towards the end of 2017 went through significant political change. In Zimbabwe, there was a coup, as it were, where Robert Mugabe was ousted, and the new president Mnangagwa took over as president, and they're making much more positive and much more accommodating kind of approach to investment and to industry in Zimbabwe. So there is an election taking place there later, but certainly the outlook does seem a lot more positive. In South Africa, we've got a new president as well. Wholesale changes are being made to cabinets and to the state-owned enterprises where there was a lot of corruption in the past. And certainly the approach from a mining industry has been a lot more positive. We're engaging with the new minister, and the engagement has so far been quite positive.
And also union-wise, I think it's all clearing up a bit, right?
Yeah, listen, I mean, the union, it's always, it's respectful but a difficult approach with the unions, but we do engage with them regularly, and we get along reasonably. Super. I mean, we manage it together.
Perfect. That's important, because, well, finally the workers are the capital of the company also.
Exactly.
And I think if you are respectful with everybody's doing the things right, I think everybody benefits, right?
Yeah. Listen, our vision is to create superior value for all stakeholders. And certainly our employees, our communities, the government are key stakeholders in order for us to have a sustainable business. So, certainly that's a key area that we look at.
Definitely. Fantastic. Well, I would say well done. Thank you very much, James. And I look forward to speak to you soon, and we look forward to your numbers then.
Great.
Because we want to see good margins.
We'll try.
Super. Perfect. Thank you very much. Yeah, ladies and gentlemen, there was James Wellsted, the Senior Vice President of Investor Relations from Sibanye Stillwater. And you heard it, everything is becoming now and going much, much better. And the company is back on the growth path on the palladium, platinum side, but also on the gold side. They have a long mine life on all of their mines. And still they have a lot of time to do more exploration before they would, I wouldn't say going into trouble, but before they are getting maybe a little bit too less in the mine life for the valuation. But also I think it's a little bit of really overrated the debt situation in the company. So I think the stock price has a lot of potential upwards, honestly. And I would say check out the company. Thanks for watching us. Bye-bye from Munich.